Special assessments are an important part of real estate taxation because they target specific properties that receive a direct, special benefit from a public improvement. While general ad valorem taxes fund broad community services such as schools, police, and roads, special assessments finance particular projects that enhance value for a defined group of parcels. As a real estate professional, understanding how special assessments are created, calculated, and enforced helps you explain extra costs that may come with owning or purchasing certain properties. A special assessment is a tax levied against specific properties that benefit from a public improvement. Common examples include assessments for sidewalks, curbs, street paving, lighting, water service, and sewer lines. The key idea is that not all properties in a jurisdiction are charged, only those that stand to gain a direct, measurable benefit from the improvement. Once the project is paid off, the assessment typically ends. Consider a canal front subdivision where a dredging project is approved to deepen the canals. The project cost is $50,000. There are 100 lots in the subdivision, but only 50 have direct canal frontage. Because only those lots receive a special benefit from deeper canals, the assessment is applied to those 50 lots. If each lot is deemed to benefit equally, the special assessment is $1,000 per lot. After the cost of the project is recovered, the assessment ceases. Special assessments may be apportioned in several ways. They may be split equally among benefiting parcels, calculated on a front-foot basis. For example, cost per linear foot of street frontage, or allocated based on the relative value or size of the properties receiving the improvement. The goal is to distribute the cost in proportion to the benefit received. Special assessments create tax liens on affected properties. If a taxing entity initiates the assessment, such as a city deciding to install new sidewalks, the resulting special assessment lien is considered involuntary because property owners did not directly request it. If property owners petition the local government for an improvement, such as requesting sewer extensions, the resulting lien may be considered voluntary because owners initiated the process. Either way, a special assessment lien attaches to the property and must be paid, or it will remain as an encumbrance and may eventually be enforced through foreclosure if unpaid. Special assessments are often paid in installments over a period of years, making the cost more manageable for owners. A city might allow repayment over 10 or 20 years, adding the assessment to the annual property tax bill. In many jurisdictions, property owners have the option to pay in full upfront or prepay the remaining balance at any time. For buyers and sellers, it is important to know whether a special assessment is outstanding, how much remains unpaid, and whether the buyer or seller will be responsible for that balance at closing. Special assessment districts are created to define which properties will be charged the tax. These districts may overlap other tax boundaries but exist solely for the project in question. Unlike permanent tax districts, such as school or fire protection districts, special assessment districts are usually temporary and limited to the lifespan of the improvement's financing. When the improvement is fully paid, the district may be dissolved or no longer levy assessments. Special assessment taxes can significantly affect affordability. For instance, a special assessment of $1,200 per year to maintain sewer lines adds $100 per month to the effective cost of ownership. If buyers are unaware of this additional obligation, their budget and loan qualification may be impacted. Real estate professionals should encourage buyers to review tax records and ask about any active or pending assessments before completing a purchase. For income tax purposes, special assessment charges that pay for improvements adding value to the property, such as new water lines, sewers, or streets, are often treated differently than general property taxes. In many cases, these charges are added to the property's basis rather than deducted like ordinary property taxes, because they are considered capital improvements. While your role is not to give tax advice, you should recognize that these distinctions exist and suggests that clients discuss them with a tax professional. In addition to local special assessment liens, investors and owners must also understand that other kinds of tax liens can attach to property. For example, when a taxpayer fails to pay federal income tax, the Internal Revenue Service may file a federal tax lien. This lien is a legal claim against the taxpayer's real and personal property. If the tax remains unpaid, the IRS can enforce the lien by levy, seizing and selling assets to satisfy the debt. While this type of lien is not a special assessment, it is another example of how tax obligations can become secured by real estate and must be cleared before conveying clear title. Taxpayers may work out payment plans or settlements with the IRS, but until the lien is released, it remains a serious encumbrance that must be addressed in any transaction. Understanding special assessments and related tax liens is crucial in evaluating encumbrances, estimating total ownership costs, and delivering accurate information about a property's financial obligations. Review summary. Special assessments are targeted taxes imposed on properties that benefit directly from public improvements, such as sewers, sidewalks, or street paving. These assessments are based on project cost and allocated among benefiting properties according to benefit received, which may be equal shares, front footage, or value-based apportionment. Special assessments create liens on affected properties and are usually paid over time through installments added to property tax bills. They are distinct from general ad valorem taxes, which apply broadly to all taxable property within a jurisdiction. Buyers must understand any existing or pending special assessments because they can significantly increase the cost of ownership. Additionally, other tax liens, such as federal income tax liens, may also attach to real estate and must be resolved before clear title can be delivered. Discussion. Why are special assessments considered more targeted than general property taxes? Answer. General property taxes fund broad services across an entire jurisdiction, while special assessments are imposed only on properties that receive a direct, specific benefit from a particular improvement. How can special assessments affect the affordability of a home? Answer. Special assessments increase the total annual cost of ownership, which can raise monthly expenses and affect a buyer's ability to qualify for financing or stay within a budget. Why is it important for a real estate professional to identify outstanding special assessments before closing? Answer. Because unpaid special assessments are liens on the property, they may need to be paid or allocated between buyer and seller at closing, and they directly affect the buyer's future tax obligations. How does a federal tax lien differ from a local special assessment lien? Answer. A federal tax lien results from unpaid federal taxes and can attach to all of a taxpayer's property, while a special assessment line arises from a specific local improvement and attaches only to the properties within the assessment district that benefit from that improvement. Closing remarks. Special assessments are a powerful tool for local governments to fund specific projects that enhance neighborhoods, but they also represent significant obligations for property owners. As a real estate professional, your role includes helping clients understand where these assessments come from, how they are calculated, and how they impact the cost of owning and transferring property. When you combine this knowledge with your understanding of ad valorem taxation and other tax-related liens, you are better equipped to guide buyers and sellers through a complete and accurate picture of the financial responsibilities tied to real estate.